about 6 million people in the U.S. alone are either in imminent default or they will be short selling or doing something within the next year. The biggest reason why is obviously 2007, the median price in LA County was $550,000. As of February of this year, it's down to $315,000. So anyone that bought a home from 2007 all the way up to about a year ago, actually a year and a half ago, they're upside down in their property. Now what the banks are doing is we obviously do not want these foreclosures. We either want to make these people modify, keep them in their home, or short sell the property so the values don't continue to drop. So we are working with customers. Wells Fargo alone modified 650,000 customers to keep them in their home by either lowering their principal or lowering their interest rate to make the home affordable. Riverside County, just another statistic here, the median home value in Riverside County is down to about $195, and San Bernardino County is down to $150. In last year alone, 2010, we have 1 million homes repossessed. That's not including anything that went short sale, just repossessed and then became a foreclosure. Now, the biggest thing that happened last October, all banks stopped their foreclosures because now they actually need to review all the documentation. So even though foreclosures, the percentage is down, there's more people defaulting on their mortgage, and now it's actually taking us about 17 months from the moment they stop making their payment to the time we actually repossess the property. So, and we're now getting back into the foreclosure process. So what we want to do is first try to short sell this property. So we're making it easier and easier, involving other programs like ResNet and Twitter to actually get this process smoother, to get the BPOs quicker, to get these things approved quicker. Another thing that's been happening too, since a lot of people were going through modifications as they were going into default and we were stopping the foreclosures, we actually kept going and going and going, so people were in their home for about 2 years. All the lenders and all the investors now just want the properties completely off the market. So if the person is in default and files for a modification, we still continue with the foreclosure process. If we do give them an extension, it's 30 days, that is it. So once the 30 days are up, if they don't close, we basically foreclose on the property. That's another thing why we're trying to streamline the actual short sale approval. The biggest thing too, when you're doing any type of short sales, ideally, if you have a short sale and the value comes in low, you usually want to have an appraisal from the same lender. So use the same lender that you're doing the short sale with, so you can actually get the value lower. They base everything on either a BPO or an appraisal that's done by their own company. Well, one thing that is happening, they assume the government will continue buying bonds, so the rates will probably stay in the low fives, mid fives, which is a good thing. The market will still keep going. I think this is all shifting primarily to all purchase loans. Refinances are out the window, so it's either modification or they're going to be doing short sales. So it's something really to focus on. Sales-wise, this is last December. It was transactions just in Southern California alone. There was about 20,000 sales that happened in California. In the San Gabriel Valley, it was about 8,900 transactions, and out of those, about 18% were short sales, and then of course the rest were regular sales, and the other ones were foreclosures and properties. Now the biggest thing is most of these properties, the people are getting a lot of deals when they buy cash, but the banks are also watching what everyone's doing. Last year, Wells Fargo lost $10 billion due to fraud, whether it was a short sale, whether it was a foreclosure, buying it back, letting it go, loans defaulting, buybacks. So you're going to see another big thing that's going to be happening in the market. They're actually going to start being a little bit stricter on what they sell the property for. They don't want it below market, they want it at market, because obviously we're losing money, and they don't want the flops, they want the flips. If someone buys it as an investor, they want them to fix up the property, to do something to the property, so when they do sell it for a profit, they actually improve the property conditions.
States is the new NMLS licensing service that the government has put in place in order to try to help the market stabilize itself. And what they're trying to do is get the best of the best as lenders to work for you and the clients. So it pretty much explains what the National Mortgagee Licensing Service stands for and what it does, and how HUD is going to implement it in day-to-day. Actually, starting April 1st, they've already put this into play. the National Mortgage Licensing, or our NMLS number, is going to be tagged onto each and every FHA or VA, any HUD loan. It's going to follow it for the life of that loan. Our name and our number will be tagged on there in case any defaults happen in the future, and then they will reference back to that particular person, no matter if it's 5, 10, 20 years from now. So that would be on the first one. On the second one that I brought is actually Mortgagee letter 11-10, which is the 10th letter of the year. And what it's stating is come Monday, April 18th, HUD is changing the monthly mortgage insurance premium. It's going up, everybody. So what that means, it's going up 0.25. We know it as basis points. Everybody in the real world knows it as 0.25%, a quarter% up on their monthly mortgage insurance premium. So in effect, what that means for you guys and the clients is they're going to qualify for a little bit less purchasing power because their monthly payment is going to rise up. HUD is doing this because they don't want to go bankrupt, pretty much. A lot of people are still defaulting out there. It's not just in California. We're talking the whole United States. So that's the reason they have to look at the future and implement adjustments ahead of time before everything collapses like it did a couple years ago. So that's the second letter. I know this is a lot of information, but this is the items that we have to go through and read all these mortgagee letters and help with the knowledge that we have. There's an example on page 2 in regards to how it's going to affect from right now to the adjustment come Monday. And these are for case numbers ordered Monday. So if you have clients that are ready to open escrow, do so, order your case numbers by tomorrow. Oh yeah, tomorrow is Friday. And come Monday, this new law takes effect. And the last mortgagee letter that I have for today's explanation is actually mortgagee letter 2011-13. And what it is an extension to the 90-day flip rule. The government has extended it for 1 more year as from the date this letter was printed, which was February 17th. They will allow the 90-day flips to continue, but for 1 more year. And this one is a very long, because they really get into detail and explain why they're doing it, to what type of properties, and who it's going to benefit. And the other thing that it implements, that they are not going to extend it again. I mean, they explain it about 5, 6 times in this letter that they are not going to extend it again. So pretty much this is the information that I have. In order for ourselves to understand this, mortgagee letters, they're printed as changes go on day by day. That's why it's very good to get together with affiliate and a lender that is extensive in the knowledge. In 2009, we had 53 mortgagee letters, which means we almost had a change every single week. There's 56 weeks in the year, and there was 53 letters printed. So there was 1 change per week. So that's why you saw us running around like crazy, because there was a change every single week. And that's 2009. All this information is on HUD's website. It's there, it's printed, and the letters stay there for about, I think it was about 15 years. So you could reference back to them. 2010, we saw 43 letters printed, so almost every week and a half. And in 2011, so far, 4 months into the year, and we're at 16 letters. So we're pretty much 1 per week so far. I think we're 16 weeks in the year, so we've been seeing a change every single week. And that's pretty much all the information I have for you this morning. Thank you.
Camera.
If anyone didn't get a Wells Fargo package, raise your hand. Mark's passing out right now. Thank you. I'm going to shift the focus a little bit since you heard something, up-to-date changes on the short sales and some of the changes on the guidelines, some of the mortgages that are seen today. As you can see that there's a lot of changes, and that those changes are happen rapidly. So that's why we as a mortgage law officer, we have to keep up to date with all the changes. It seems to me we never get to have a chance to catch up. As soon as you'll hear something, we'll learn something new popping up again. So that's why there's a lot of time that you be struggling and frustrating. Like, my client was, so good. Why is that last minute we have a problem? Why is that my client cannot get a loan? Why is that there's so much hassle and headaches getting a loan? Well, I'm going to shift the focus a little bit. Hopefully this will help you to actually close your deal. Your non-full cash buyers, their deals a little bit smoother or quicker or even hopefully on time. Basically, we hear a lot of time that, or too many times that your client has a great FICO score, put in large down payment, but still there's a problem, there's an issue, they cannot close, there's last minute conditions you need to fulfill, and sometimes that condition could be so ridiculously unreasonable. It's not really because the lender's being picky, it's just keep in mind those loans we got, we have to resell it, we have to sell it to the secondary market, and mostly those are secondary market have to follow Fannie Mae and Freddie Mac guidelines. Okay, so those are things really asked by Fannie Mae and Freddie Mac, and they are changing their rules, they are changing their guidelines, they are changing the way they accept the package, rapidly. Once we hit any problem or any issues, then we have to deal with it. And as lender, we hate to have any kind of buyback. Okay, so that's why a lot of time you hear something like something you can do 2 months ago, now you cannot do anymore. You're gonna hear that a lot. Okay, so I'm gonna share a little bit. Hopefully, this is gonna help you to close the deal a little bit smoother and on time. Now, I want to take a little survey real quick. How many of you actually like to, before you actually taking an offer or taking a client to see a house, how many of you actually ask for a pre-approval letter? Show your hands. Perfect, okay. So I can see most of you actually agree with me that a pre-approval letter right now is essential. It's actually a piece document you needed before you actually work with a client or even look at a offer. It is very important to have that, as a matter of fact, because whether that is you need to have that fulfill seller's requirements, or just for your information to determine if the client's well worth it to take the property as requested. That would be something that you can determine, before you actually spend your time, efforts, or even driving it around, spend your gas money on that, and which is important. But more importantly, as I personally think, the purpose of that is actually to really give the client a chance and you a chance to actually know their limit and ability to buy a property to a range if they can afford. Okay, and we hear a lot. We see a lot of clients. They say, "Well, no problem. I can do this. I can buy this property, and I got a large down payment on stuff." After you spend the time, that a lot of time they cannot really afford or get a loan simply because other area they cannot be qualified. So, as my personal opinion, that pre-approval is a very important process for the whole transaction in the beginning. As a matter of fact, this is something that actually you can do ahead of time. You don't have to wait until your offer being accepted or your transaction is going. At the time you start worrying about that, because usually, as you know, most of the good deals right now, they require a very short period of time to close. And most of the purchase right now, they are asking for 30 days of closing. So in reality, the 30-day closing, you don't really have 30 days to close a deal. You only have about 22 days, working day to work on a file. Let's say you take out the first 3 to 5 days for the compliance we have to meet before we order appraisal. Take out another 3 to 6 days in the end for you to order loan docs, closing, and signing closing. You don't have much time to process this loan. So basically what you need to do when you have a chance to do a pre-approval, you really want to make that pre-approval process worth a while and make that a meaningful pre-approval, because at a time you have a chance actually to identify any kind of problem ahead of time. Take care of the problem at a time, or even have any kind of alternative solutions, to offer the client. And that way that you don't have to really worry about that, that 17 days condition coming up, that 30-day closing days coming up, are you going to be able to close a deal, okay? So basically, pre-approval, that consists probably in some area. One, oh, by the way, I pass on my a flyer or checklist. That is a checklist I think will be generally used for any lender. You can see those documents are pretty much the thing we asked for. Okay, even a pre-approval at the pre-approval stage, or actually in the actual loan processing stage. Okay, those are pretty detailed, so you can see that there's a lot of documents we require when you do a full loan process. Okay, so pre-approval. Generally, when we talk to clients, we ask probably in this area. One, we need to determine occupancy. Okay, it seems to be a lot of people want to buy the property as unoccupied because of probably less down payment, better interest rate, a little bit leniency on the guidelines. Unfortunately, a lot of times that really doesn't happen. Okay, the reason I'm saying that because it can be various reasons that the occupancy the borrower actually or the client actually desire is not really something would happen when you get to the underwriter and in underwriter's eyes. That could not happen. Give you an example. Let's say they're buying a property in the same area, even though in reality they're actually going to live in the property, but they are buying like 2-3 blocks away. That could be an issue if they want to make it as unoccupied and they still want to keep the existing property they're living right now, actually obtain a property. That could be an issue. So that'll be something you want to look into to see if it's reasonable, if there's a strong motivation to actually turn that into actually underwriter will accept it as unoccupied. Now the reason